Welcome back to the Old Fashioned Real Estate Show. My name is Jeff Holst, and that is Brian Leverage. And I'm not letting him say anything else because he's messed this intro up like 4 times. So this episode, we are talking about what, Brian?
The 5 things that can trip you up in real estate investing.
Close. The 5 things that we see new investors doing wrong on their very first deal.
Yes.
Now, be sure to stick around.
That's what I said.
Close. Be sure to stick around to the end because that 5th thing will actually solve the other 4. So if you mess up the first 4 and you get the 5th one right, you're totally golden.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
All right, so Brian, what is the very first thing that you see people doing that's a gigantic mistake?
Well, usually the first thing people do when they put a rental property under contract or an investment property is due diligence.
Right. So you're thinking they don't do enough due diligence?
Yeah. People sometimes they try to skimp on like inspection costs or things like that. Oh, I'll have a contractor friend do them, or I'll just do them myself. And if you don't really know what you're doing or what to look for, well, then you can quite easily miss things that can really change your numbers, which then leads to the next thing, which is...
Well, but before that, so just real quick, like what would you do to avoid that? Like what should somebody do in the due diligence that maybe they're not thinking of doing?
I think basically is hire professionals whenever possible. You'll learn from them as you go, and better to pay, for their knowledge on the front end. Basically, it's almost like making an additional investment in yourself, right? A good home inspection company, for instance, they crawl under the foundation, right? Like, I'm not going to do that. I'm almost 50 and I hate spiders. So, they go under, they might tell you, well, hey, you got a bunch of water under here and that's rotting out your floor joists and maybe your subfloor. And if you didn't do that yourself, you would have missed that. And that's a major problem. That could cost tens of thousands to repair, just as an example.
Yeah, sure. I mean, there's all sorts of possible things they could discover. The sewer lines could be broken or clogged. Right. There could be foundation issues that you can't see readily from the outside of the house. Yeah. So there's all sorts of things that could be discovered during that. A big mistake number 1 is not doing enough due diligence.
Which kind of leads to number 2, which is...
Well, I don't know which one you
budgeting.
That's fair. Budgeting, right.
Yeah.
So when you're talking about budgeting, what you're talking about is preparing a renovation budget for the most part to sort through what the costs are going to be to get the property to rentable condition.
Yeah.
That's the kind of budgeting you were talking about.
Yes, correct. Yeah.
And where people can go wrong here is they can dramatically underestimate the budget. We've been guilty of this, especially given the COVID situation where all of a sudden this inflation came out of nowhere. But the reality is if you adequately budget for things and put in contingencies, which is a big part of it, you can avoid that. But a lot of people just think, oh, I can just slap a coat of paint on and maybe replace a toilet and I'm good to go, and that's not always the case.
And I think it's probably, this will be a good spot to point out that when you're undertaking a renovation, first off, estimating renovation expenses is difficult even for seasoned professionals because there's a lot of stuff that's hidden inside the walls, etc., that often, depending on your scope of work, you may not discover until you get into it, right? Which to your point means you should kind of buffer, add for stuff that nobody's all knowing or omnipotent, right? So you're, plan for it on the front end, number 1, but also work with people, contractors, or at least have a renovation plan that covers, don't cut corners with things, right?
Yeah.
Like don't band-aid stuff, do it once, do it right. It's going to be more expensive to fix down the line because of inflation.
Yeah, well, that's definitely the case.
Yeah.
And related to that actually is picking the wrong project. That's really the third. Obviously, if you do your due diligence and you come up with a budget, you can avoid picking the wrong property. But Not always. You know, and experience has taught us that sometimes properties are going to be more worth than you think they're going to be.
Mm-hmm.
But when you're avoiding picking the wrong property, the things that you can do is like, well, obviously the due diligence and the budgeting, but the next thing you can do is you can really think clearly about what type of asset you're looking for. Are you looking for single families, or are you looking for duplexes? What markets you're looking in. Don't necessarily just buy in your neighborhood because it's your neighborhood. Don't necessarily just buy in your town because it's your town. If you live in an area where rents are, 0.2% of the purchase price, it probably isn't going to make a very good rental. Right. Your mortgage payment's going to exceed the rental.
In other words, try to divorce emotion from the decision-making process.
Exactly.
Yeah.
Don't fall in love with the property. That's really the third thing is this. Just make sure that you're buying a property based on the fundamentals, based on the numbers, based on your budget, and based on your due diligence. Not because you love it. It's really easy to fall in love with a property, which is probably fine if it's your personal home.
Yeah.
But if it's an investment property, it's no bueno.
Absolutely. Right.
All right. So what is number 4?
Number 4 to me is bad financing, and that could be a couple different things. A lot of people try to obviously minimize their out-of-pocket to get into a property, and who doesn't? Because generally it translates to a higher ROI, right? Except for now, but
right. Well, we did make a whole video about negative and positive leverage, but for sure, when interest rates exceed the return, you're better off paying cash. But financing terms matter, right? And we've done videos about this before, but the short breakdown is make sure that you have enough of a debt service coverage ratio. If you don't know what that is, that's just
it's a factor of your net operating income divided by your mortgage payment.
Exactly. It's a ratio that says, hey, I have this much excess above the cost of mortgage financing costs. So make sure you have a good debt coverage ratio. You're going to want, banks are going to require 1.25, 1.3, but you probably want 1.4, 1.5 because you want to
be more conservative than you think. Yeah.
A little fudge factor.
And a lot of investors, BRRRR is a popular acronym, has been for a while now. Buy, renovate, rent, refinance, right, or something like that.
And repeat. Yeah. I think there's an extra R there, but.
And so part of that process is typically investors will go in and they'll do hard money on their acquisition financing, right? Not really having thought through, well, how do I get out of the hard money loan? And that can be a critical mistake, because if you're not approved for your takeout financing, probably don't want to take on the hard money financing.
Right, you gotta have a backup plan, right? So it might be that you can sell the property, and that's fine. You might take it with hard money, and your thoughts are, I'll either refinance or sell. And if you have a pretty good idea of what the refinance terms are going to look like, that might be an acceptable risk. But this doesn't apply just to your very first rental property. This applies to everything. We see this in multifamily. Some of the big operators were buying on bridge loans, which is kind of like hard money, right?
Yeah.
The idea is you get an interest-only loan for a year or 2 years.
Make the rents way up.
Yeah, raise the value, then go ahead and refinance as something amortizing. And with interest rates rising so suddenly, some of these guys have gotten stuck in situations where there have been some gigantic foreclosures in that market because they didn't have good financing. So this is a lesson that you want to learn for your first investment property, but frankly, you want to learn it. It's important.
Now there is one thing,
that
can really solve all of this, right? Because these are all mistakes that frankly are not uncommon as we learn and evolve and stuff. But probably the most important thing, the biggest mistake people often make is
lack of adequate capitalization, which is a fancy way of saying they don't have enough money.
Yeah.
You should never invest your last dollar in a piece of real estate. You need to have some cash reserves.
Yeah. No, so much truth in that. We, over the years, I've done a few deals where basically by the skin of my teeth, and it was probably luck as much as anything, and time has taught me that keeping a lot more money on hand than I thought we would even need solves a lot of problems. Because if you have, say, extended vacancy and no rent to cover your mortgage, well, guess what? You got the money sitting.
Yeah, and that's
an AC evening. going out after you fixed up your, something like that, unexpected.
And cash flow can solve some of this, but unless you have a lot of cash flow, you better have a really big capital reserve. Because cash flow can go away, right? So one of the things that I think that's really useful with a capital reserve is that it can bail you out of all of the other problems that we talked about, right? So the fifth one is inadequate capitalization, but just to review, the first one was lack of due diligence. Right. So if you don't do your due diligence right, and you discover something that you didn't know was there, and you have to pay for it, capital reserve solves it. If your budget was off, capital reserve solves it. If your financing is off, cash will solve it. And so on. Right. So it goes through that whole list that way. And this is something that I heard really early on from a certain former president that I don't like to mention on the show because it's controversial and stuff. but he said cash. One thing he said this after he went through the 90s recession, right? And he was in a really bad financial spot. He said one thing I learned is that cash will solve all problems. And then the other thing he said is it's always good to have cash in a recession. And I think that's really the fundamental point, right? Is if you have enough capital, it'll bail you out. The real estate market is super forgiving over the long term if you can survive for the long term. And the way you survive is you have enough cash. Be conservative. All right. So thanks again. And if you're liking our content, be sure to hit that thumbs up and subscribe to the channel. Probably share it with your mom, something like that.
We'll see you soon.